Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage, and welcome to another edition of Java with Jared. Hope you guys are doing fantastic. Well, we had another good week for interest rates. They actually finished the week again a little bit better than where they ended last week, so that's good. We saw new home sales come in. That was a little bit weaker than expected. It only showed about 414,000 new homes. Expectations were closer to the 457,000 range, so that was a little bit weaker than expected. Also on housing, we saw Case-Shiller come in. That showed the year-over-year increase at about 13.7%, which was a really good number. However, the 20-city index, that showed on a month-over-month basis a little bit weaker than expected. It only showed an increase of about 0.1%. So the pace of appreciation could be slowing here a little bit. But overall, still it was up, and that was a good thing. Also, on economic data, we saw that the Fed meeting, that happened, and we saw that there was really no change to Fed policy in terms of changing the Fed funds or discount rate, which was as expected. And also as expected, the tapering will continue. Last Fed meeting, they announced that they would start buying less bonds and mortgage-backed securities and treasuries to the tune of $10 billion. And it was expected another $10 billion, so going from 85 to 75 last month, and then 75 now down to 65 was expected, and that did happen. The Fed will continue to buy less mortgage-backed securities and less treasuries. However, there's just less supply out there right now, so that really isn't hurting interest rates. And then we also saw fourth quarter GDP come in, and that was a little bit stronger than expected. Fourth quarter GDP came in just a little bit stronger, which was no huge worries in terms of, it was kind of a Goldilocks number where it was not too hot, not too weak. Now, last week I talked to you about the Super Bowl index. We have the Super Bowl coming up, as you know, and there is a lot of indicators out there, but one of them that I find interesting is that they have the Super Bowl indicator, which states that if an AFC team, which would be the Broncos, win the Super Bowl, then it's likely that the stock market will go down. If the NFC wins, statistically what has happened is that the stock market goes up. Now, this is just random. There's really no correlation whatsoever, but it's a little fun number. And it's actually been pretty darn accurate. It's close to 80%. So I'm thinking the Broncos will win the Super Bowl. I don't know about you guys, but I'm hoping for that. And that actually may help interest rates a little bit because historically, if the stock market suffers, then usually interest rates do better. So you have two things to hope for, unless you really want your stocks to go up. But if you want interest rates to continue to be low, and you also want the Broncos to win, you get both things if that happens. So that's what's going on with the Super Bowl effect. We'll keep you informed with what goes on with the market. If you have any questions, please give us a call. Hope you guys are doing great. Thanks for joining me with Java with Jared. And if you have any questions, please feel free to give us a call, and we'll talk to you soon. Go Broncos. Bye-bye.